Hello dear students, welcome to the Erika's Commerce and Management Academy. Accounting Standard 1 we have seen. Today we'll see Accounting Standard 7. What is this 7 says? 7 has described about cash flow statement. Earlier this statement was the Accounting Standard statement 3. 3 was the cash flow statement. Now at present 2024 onwards, the cash flow statement has described in Accounting Standard 7. Able to remember? Now you know that cash flow statement already we have learned in management accounting or any other subjects already covered in our channel. There's a specific playlist for cash flow fund flow statement analysis. What is this cash flow statement? Cash flow, how the cash is flowing, whether inflow or outflow, both we are discussing into the cash flow statement. We know that trading account, profit and loss account, balance sheet we prepare, but out of these three, do we know about a depth information about the cash? No. Simply in balance sheet you will find on the asset side cash at bank, cash in hand, that's it. But about the cash inflow and outflow and depth information, a detailed information like how the cash is flowing, how much is inflow, how much is the outflow. Inflow means what we are getting inside of the organization. Outflow means what we are spending outside. Whatever cash is flowing outside, that is cash outflow. Cash inflow, cash outflow, and cash liquidity position, all these things we won't be knowing through the financial statements. That is the reason we are preparing cash flow statement. Now cash flow statement preparation according to Accounting Standard 7 direct method we will see in this video. Now what is cash flow statement? In one sentence we can say cash flow statement refers to the inflows outflows of the cash and cash equivalents. What it refers? It refers to the, I'll take another marker. Cash flow statement refers to the inflows and outflows. Inflows and outflows of the cash and cash equivalents during a specific period of time. During a specific period of time, generally 1 year, 2023 to 2024. How is the cash flow? Between two periods. It can be 2022 to 23 1 year, 23 to 24 1 year, or you can take one firm to another firm also. Cash inflow of firm A, firm B. That also you can calculate it, you can compare it. You will come to know which firm is running well, which firm is giving better results. In that way also, for comparison point of view, 1 year to another year, one firm to another firm, one branch to another branch, you can prepare cash flow statement that talks about the inflows and outflows of the cash and cash equivalents during a specific period of time. That's all. This is about the cash flow statement. Okay. Cash flow statement, Accounting Standard 7. In short, we are saying SOCF. SOCF means Statement of Cash Flow. Statement of Cash Flow. Okay. Now let's see few objectives. What are the objectives of Indian Accounting Standard? Indian Accounting Standard 7, SOCF. Standard. Statement of Cash Flow Statement. We have 5 objectives. Very easy to understand. First one is to help the user of financial statements by providing details of cash and cash equivalent. Whoever is using the financial statements, for them cash flow statement is going to be helpful to understand about the cash and cash equivalent. Both information we are giving in depth. This is the main object, and the second object is to analyze liquidity and solvency position of the firm. You'll come to know the liquidity and solvency position of the firm. So this is also another object, very important object. Liquidity and solvency position. This cash flow statement is going to reveal very clearly. Next objective is to determine the reason for changes. The reason for changes in cash balance among the two different periods. Why there is a change in the cash? Reason for changes in cash balance. Why there is a change? That also you'll come to know. Last year it was say 20,000. This year it is 30,000 or 10,000. Why? Increase or decrease? What is the reason for that? So this will provide you. And in the same way, another objective is to show the cause of reduction in cash balance. To show the cause of reduction in cash balance. Sometimes cash may be decreasing. What is the reason? To show the cause of reduction. Why there is a reduction in cash balance, that also will come to know. And second last objective is to enhance comparability of various firms. Comparing with various forms, one form to another form. That's very easy. So this is also one of the objects. Total 5 objects are there. Very easy to remember. First one is that whoever is using the financial statements, for them cash and cash equivalents information is giving. Second one is to analyze the liquidity and solvency position of the company and the reason for the change in cash and cash equivalents. Then cause of reduction in cash, and to compare one firm to another firm. These are the main objectives of the preparation of cash flow statement. Now advantages or benefits of cash flow statement. We have total 5 benefits or 5 advantages. First one is ascertainment of cash position of the firm. By preparing cash flow statement, you will come to the cash position, where we are standing. Do we have satisfactory cash balance or not? That will come to know. This is the first benefit. Second benefit is identification of fluctuations in performance. Sometimes there may be lots of fluctuations. Cash is increasing, decreasing drastically, and sometimes to some extent it is increasing. So why that fluctuations are happening? This you will come to know through the cash flow statement. So identifying the fluctuations in performance. Next, provide comparisons with other firms. This already we have discussed here. Objective, the same objective can be a benefit also. That benefit is the same point. Provide comparisons with other firms. Then identification of liquidity position. Liquidity position also you can identify very clearly, because total information related to the cash and cash equivalents is mentioned in the cash flow statement. So the company's liquidity position is very easy to understand, so that you can decide whether liquidity position is decreasing, not satisfactory, then increase it. It's up to the mark, good, then you can say company is going very well, like you can decide. So anyhow, the liquidity position of the company you will come to know through the cash flow statement. And last one is forecasting future position. When cash and cash equivalents, if you come to know, future forecasting is very easy. Going very well, cash is up to the mark, liquidity position is good, then your prediction for the future is different. If it is not good, then your prediction, your forecasting, your planning, it has to be much careful, and also you need to be alert. Like whatever it may be, whether it's a positive or negative, that forecasting is possible. So these are the main benefits or advantages of the Indian Accounting Standard 7. If I say Indian Accounting Standard 7, easily you must say this is about cash flow statement. Need not to say cash flow statement is Indian Accounting Standard 7. Clear? So objectives and benefits you have seen. Now how do you prepare the cash flow statement? Before going to that, you must remember one thing: applicability of Indian Accounting Standard 7. Applicability. For whom it is applicable? Applicable to all, any company. It is mandatory also. Any company, they have to prepare this a cash flow statement. It's not that so and so companies are exempted. Nothing is like that. For every company, Indian Accounting Standard 7 is mandatory and compulsory. Okay. Now coming to the presentation and statement of cash flow statement. Before going to the cash flow statement, Accounting Standard 7, you need to prepare one thing, that is adjusted profit and loss account. Did you remember adjusted profit and loss account, what we have prepared already? Before adjusted profit and loss account, we need to prepare one more account, that is profit and loss account. Just I'm giving you a small introduction. First we'll be preparing profit and loss account, P&L account. Then after that we have to prepare adjusted P&L account. What is profit and loss account? What is adjusted profit and loss account? Profit and loss account talks about general information related to the financial statements. After preparation of profit and loss account, we'll be preparing adjusted profit and loss account. Adjusted profit and loss account means the extra items which are not taken place, which are not included in the profit and loss account. Those items will be writing into the adjusted profit and loss account. Okay. Simply the format will be like this only, just like profit and loss account, debit and credit. Most of the time you will be starting with the buy net profit. How do you got the net profit? Net profit from the profit and loss account debit side. Here in profit and loss account, you got net profit on the debit side. The same net profit will be transferred from debit to credit. And here you will be writing all the expenses which could not take place in the profit and loss account. Those expenses will be writing on the debit side, like provision for depreciation or depreciation, loss on sale of asset. In the same way, profit on sale of asset here, and any income, any other income, dividend or any other income will write. At the end of the time, you will be getting the net profit or net loss. Operating profit will say, or whatever it may be. So that leave about this, whatever you are getting. Now, did you get before preparation of cash flow statement what you have to prepare? Adjusted profit and loss account. This you have to prepare. This is the step number 1. This need not to prepare. Already in financial statements it's given. What we are preparing first? Adjusted profit and loss account. Then after that we are preparing a cash flow statement. For preparation of cash flow statement, this is second step. What we are saying, presentation of statement of cash flow, Indian Accounting Standard 7. This is about direct method. How many methods are there to prepare the cash flow statement? 2 methods. Direct method, indirect method. Indirect method already I taught. That link you can check it out in the playlist. Okay, cash flow and fund flow statement separate playlist is there. There you can check. Now right now we are talking about direct method. How do you prepare cash flow statement? Means mainly 3 items you have to remember. Presentation of statement of cash flow statement. 3 items. One is operating activities, investing activities, financing activities. Okay, so 3 activities: operating, investing and financing. If you understand 3 activities, done. Cash flow statement is done. You understood it. Now let's discuss each and every one. First item, operating activities means cash flow from operating activities. What do we write it in the operating activities? It talks about the current assets and current liabilities. Operating activities, operating expenses, operating income, regular wise transactions. Those transactions only we are taking in the operating activities. Here first we'll start with net profit. Net profit, something was given in the problem. With that net profit we'll start. We add some transactions. We deduct some transaction. If you remember that, this is over. What do we add? One is cash received. Whenever you receive any cash, that is to be added. Received any cash, add. Apart from that, we'll talk about current assets and current liabilities. If current assets are decreasing, I have put an arrow mark, downside arrow mark, means current assets are decreasing. In the same way, current liabilities are increasing. In any of such case, these 2 items we are adding. Cash received, current assets decreasing, current liabilities increasing. Add. If you understand this, what you have to deduct? Here cash received added. Now cash payments deduct. One is cash payments will deduct. Another one is here current assets decreasing added. Opposite to that, current assets increasing. Current liability increasing added. Now here current liability decreasing added. So that is why if you are able to remember this is quite easy. Cash received, current assets decreasing, current liabilities increasing. Here what we are deducting, cash payments decrease, we deduct, and also current assets increasing, current liability decreasing, yes. So these items will deduct, only two items, so that you get cash flow from operating activities. Okay, operating activity, very simple. Net profit we have taken, we have added two items, deducted two items, whatever is given according to the problem. Cash flow from operating activities, clear? Now we'll talk about cash flow from investing activities, operating activities, investing activities, financing activities. We are discussing about investing activities, cash flow from investing activities. Investing activities means it talks about the fixed assets only. Investment, what do you invest? You invest on assets. So that is why cash flows from investing activities. Remember simple funda. Sale of fixed assets or purchase of fixed assets we consider, not anything else under this category. Sale of fixed assets or purchase of fixed assets. Sale of fixed assets we add. Why do we add? Because we are getting cash. When you sell, getting cash. So add. Now purchase of fixed assets, deduct. Add sale of fixed assets, purchase of fixed assets, we are deducting. Why we are deducting? Purchase means cash flow is going, cash outflow, so we have deducted. Cash inflow, when you are selling, inflow added. Only this funda you have to remember. Cash flows from investing activities. Am I clear about this? So 2 are over. 1, 2. Now next third one. Cash flows from financing activities. Cash flows from financing activities. So this talks about the liability side. We have shares, share capital, debentures, loans. About these three things only we are going to consider in the cash flows from financing activities. Example, issue of shares or issue of debentures. Payment of long-term borrowings or payment of loans. Raising bank overdraft. Redemption of long-term borrowings or redemption of long-term loans. Here issue of shares, issue of debentures. Issue. Redemption, paying back. Redemption of long-term borrowings and redemption of loans. And apart from the payment or raising anything, it's related to the only liability side, whatever we have like capital, long-term loan. Only these items only we are talking into the cash flow from financing activity. That's all, not anything else. Very simple, easy to remember. Now here cash flow from operating activities. Net profit you take. You'll add two items. What are those? Cash received and current assets decreasing and current liability increasing. You'll deduct two items. One is cash payments, another one is current assets increasing, current liability decreasing. So this is about cash operating activities, cash flows from operating. Now second one is cash flows from investment activities. Simple. Sale of fixed assets, add. Purchase of fixed assets, deduct. The third one is cash flows from financing activities. It talks about share capital and any long-term investments. Like I gave you 4 examples. So if you learn this cash flow statement as per the direct method, very easy. Understood? Accounting standard 7. Take a screenshot. Note down, prepare a notes clearly, and in exam you may get accounting explain about accounting standard 7. In your accounting standard 7, they won't say cash flow statement. You have to explain the same thing. Okay, a little bit elaboration is required. Am I clear? Next class will work out practical problems. Check out the playlist, many subjects already uploaded. Whatever is required, use it, and don't forget to share this video. Stay connected. Good luck.